So I think let's start off with the inflation news. Actually, and some of the macro stuff before we get into Palantir and Sam Altman and all this stuff, because this inflation news is pretty freaking crazy. And I think it's very, very important to get a deeper understanding of this stuff. So let's get into it. So first off, before we get into inflation, the jobless claims, we did get a little hotter than expected. Today's Thursday. This is where you get jobs claims. Also today after the bell, we'll get money market inflows. And last week they were outflows of about 90 billion, or not 90 billion. It was like 65 billion. So if we continue to see outflows, then we kind of know people are saying, all right, they don't want that risk-free return anymore inside of the United States when they can get equities. Jobless claims here came in at 221,000 versus 223,000. So jobless claims were still up, right? Jobless claims were still up. 223 filed versus 221. So it's a slight miss of 2,000 jobs. The market expected 221,000 people were applying for unemployment. 223,000 applied. So you got 2,000 people more than expected that applied for unemployment. You got CNN right here. We saw this headline is laying off roughly 200 employees or 6% of its workforce as it begins to embrace a digital future outside of just linear TV. And then initial jobs claims in terms of the amount of people that continue to be unemployed in America is 1.89 million. So that is about 46,000, and that's the most since November of 2021. So that is kind of why I think the 10 years ticking up. Now, remember, the nuance here is that this is actually kind of good. Obviously, not that people are losing their jobs, but from an inflation perspective, if we have higher amounts of unemployment, we have low amounts of spending. Therefore, we have a little bit less inflation. Now, granted, the inflation stuff I'm about to show you in a second kind of seems like inflation is coming down regardless of unemployment. And if you can get inflation to come down without people losing their jobs, then that is a very good thing. But I don't think the market's really tanking on this news because they want to see less inflation. This is one of the key metrics to be able to see if we get less inflation. Now, having said that, a couple of weeks ago, we got the JOLTS data, and a lot of you guys in the chat, although I'm the one wearing a hat, you guys called cap on that news. And the reason you called cap on this news is partly because of this. U.S. job openings rose by 259,000 to 8.1 million in November 2024. It was the highest since May. Including the 467,000 jump in October, this sums up to a 2-month change of 726,000 new jobs, the largest since March of 2022. However, the number of new hires dropped to 5.3 million, bringing the hiring rate down to 3.3%. This is the lowest since the 2020 pandemic, which makes no sense. If we have all these jobs available, why is the hiring rate lower, or the lowest since the 2020 pandemic when people obviously weren't hiring because there was a global pandemic? So it's a little weird that we have 8 million jobs available, but none of those jobs are being filled. Could it be that those jobs are fake? At the same time, the share of workers voluntarily quitting their jobs fell to 1.9%, also the weakest since 2020, all while the job opening survey response rate declined to a near record low of 33%, suggesting material data revisions ahead. I believe February 7th or February 4th is when we get the revisions data. And that revision data is going to let us know how many jobs do we actually have in the United States. So that stat right there says, okay, the BLS, the Bureau of Labor Statistics, says we have 8.1 million jobs, but people aren't quitting their jobs voluntarily. And based on the data we looked at, 1.9% is one of the lowest levels in 5 years. And then people aren't hiring people, or people are hiring people at the lowest level since 2020, 3.3%, which means they're just not hiring people as significantly as you would expect for an economy that has 8 million jobs open. So if we assume, if we kind of go to the other side of the BLS data report and say, no, that jobs data is fake, or at least it's inaccurately reported, the way their methodology came up to get these numbers via their surveys are just incorrect, means the labor market might not be as strong as we think. And if the labor market's not as strong as we think, kind of coupled with the stat we just looked at, that 223,000 people filed for unemployment, we may be on our way to rate cuts off of a justified cooling labor market sooner than what we think. And this is probably why Christopher Waller and Austin Goolsbee, presidents at the Fed, were being rather dovish over the past couple of weeks, because maybe they knew that the labor market wasn't as hyped up as the market expected it to be. And as a result of that, we're seeing some of the weakness right now, potentially in that labor market that could lead us to get to rate cuts. So that's the macro news in the context of rate cuts. However, this is the inflation news that dropped last night. And because of this inflation news, I think 2025 could be a really strong bull market. Again, this is one of the variables. There's a lot of other variables. We have 11 months left of the year, but still, this is one thing to keep into account. New tenant rents have declined on a year-over-year basis for the first time since second quarter of 2010. Take a look at this chart. This is incredible. New tenant rents, for those that don't know, is a leading indicator for shelter inflation. When tenant rents go up, it means that we are starting to see increased rents across the United States, in all different states. So this is a survey of all 50 states inside. It's kind of an index of the entire tenant rent capacity for the United States. And when those go up, you know that shelter inflation is going higher. And for the past 2 years, as you can see on the chart right here, 2020 all the way up. At one point, it was at 12.5%. It has only gone up. This number is coming down. This number is coming down very nicely. There's the black line right there. As you can see, lowest level since 2010. Here's another chart to give some more context right here. To close out 2024, Cleveland Fed's new tenant rent repeat index fell sharply into negative territory. This is the largest decline since the financial crisis, again, around that 2008-2010 level. So yes, these are facts that are no bueno for landlords. That is correct. But in terms of stock market investors that want to see an inevitable rate cut, because we know that rate cuts are at least one part of the pie in order to get the broader market, in particular growth stocks, small caps, et cetera, to start doing well, you need inflation to come down. And the only way for inflation to come down is if we have some level of the part of inflation, which the two biggest parts right now, or the three biggest parts, are automotive, shelter, and energy. One of those has to really come down. And so far, we haven't seen any of them really come down. Energy actually ticked up last quarter or last month. Rents might be the thing that comes down. Here's another version of looking at this chart. Now, Powell has mentioned the Cleveland new Fed rents versus that of all rents, knowing that new will lead the all. New rents just came in. Again, this was last night at negative 2.43%. Powell has explicitly acknowledged Cleveland Fed new rents many times in his press conferences. I think this is going to be the number one question on January 29th in 6 days when we get the Jay Powell press conference for the FOMC meeting. And based on this data point, which although the Fed is still lagging in all the data they look at when it comes to shelter inflation, and they've been lagging for the past 2 years, this one might be the one that gets Powell not to cut in January. That's not going to happen, but to at least think, okay, maybe a cut in March is not that crazy. By the way, the March rate cut probabilities just went to 26%. I believe it was at 15% before. So you got a material increase in the potential for a cut in May or March, even though I still think March is going to be out of the question. But May, you're at 37.8%, still lower than the consensus 55%, assuming that we're not going to get a cut in May. But if we get another 4 months of inflation at least normalizing, or CPI on the downward trajectory with new tenant rents going negative, I think it's just really going to be hard for a lot of the hawks out there to say that we're not getting any cuts, much less getting a hike. And I think it's going to be definitely hard to only get 1 or 2 cuts. I mean, there is a world by the end of the year where we are looking at 3 or 4 cuts, and that would be very, very beneficial to the broader stock market. So that's the inflation data. That's the inflation data. It's very important. Jasmine says, perfect with my lease renewal coming up. Yeah, if you're looking to rent an apartment, like I am, to be honest, maybe I'll get a little bit of a discount in the next couple months. But I mean, look, that is very, very, very bullish. CPI was what we needed to come down and normalize. CPI did begin to normalize, as we saw in that core CPI decreasing year over year and month over month a couple weeks ago when we got that data. New tenant rents, that's the big one. That is the big one. Now, in general, if that's coming down, is that great for the broader economy? One could argue no, because obviously when we cut rates, there are things in the economy that are breaking, but that's the whole nature of the soft landing, right? Or the no landing scenario. Can Jay Powell manufacture a way where rates come down, inflation comes down, and growth goes up, and then become one of the greatest Fed chairs of all time? And if he can pull that off in the next 4 years underneath the Trump administration, then maybe there is a chance to really have a nice run in the stock market, but overall the broader economy over the next 4 years. Jersey City rents are going down with months free offering on every one of these new developments. You know, the landlord that I'm communicating with, because you guys know that I'm trying to move out, they have some really nice deals as well of 1.5 to 2 months off. And, you know, they said in the summer they get even better deals because people start to move out. So that's when I'm planning to move in the summer. Maybe there's some really good negotiations I can get on these rents if they are coming down and if there is a lot of vacant inventory. But Great for consumers, great for inflation, great for the potential rate cuts. Overall, not the best for the economy, but nonetheless, given we are kind of in a little bit of a housing crisis, that is kind of good for the economy because you're getting a little bit more demand, which is going to eventually help trigger supply, get those costs to come down. But it is really good if we're looking at what is going to make inflation come down. It looks like shelter might be one of those leading indicators at this point. So there you go. That's what we got from a macro perspective. Palantir. Let's talk about Palantir. And again, we'll talk more about the macro in a little bit, but those were the main two headlines. New jobless claims come in lower than expected or higher than expected, 223 versus 221. And then new tenant rents come in much lower than expected, officially going negative for the first time since 2010, which is pretty wild, but that's what we need for inflation to come down.